You saw a perfect hammer. Long wick, small body, textbook reversal. You bought. And then, price dumped straight through your entry like your analysis meant nothing. Here's the uncomfortable truth. Most hammer candles don't signal reversals. They trap impatient traders. Everyone teaches the same thing. Hammer equals bullish. But the market doesn't reward patterns. It rewards context. And that's where most people fail. A hammer at random support. Weak. A hammer in a downtrend with no volume. Even worse. A hammer after retail traders are already buying. That's often the setup for a drop. What you're really seeing is a fight. Sellers pushed price down. Buyers pushed it back up. But here's the part no one tells you. Who won after the candle closed? Because the candle itself doesn't confirm anything. The next move does. And if you ignore this, you'll keep buying perfect setups and keep getting punished for it. Here's what actually matters: location, volume, and what happens next. If a hammer forms at a key level and gets immediate bullish continuation, that's strength. If it stalls or gets rejected, that hammer was just noise. So next time you see one, don't rush. Watch what comes after. Because the real signal isn't the candle, it's the reaction. You see that little candle on the chart, the one with the long tail beneath it, and a small body sitting up top. They call it a hammer. Sounds powerful, doesn't it? As if the market itself is striking the ground, ready to reverse. But let me ask you something. Do you really think the market is that generous? Do you think it leaves such obvious footprints just so anyone can follow them to profit? I learned early that the market does not reward what is obvious. It rewards what is understood. Now, the hammer candle, it tells a story. That much is true. Price falls, sellers press their advantage, and then something changes. Buyers step in, push price back up, and by the close, it leaves that long lower shadow behind. On paper, it looks like strength. It looks like rejection. It looks like opportunity. But tell me, what exactly is being rejected? Is it the price? Or is it your patience? You see, most traders look at a hammer and they see a signal. I look at it and I see a question. Who was in control before this candle? Who is in control now? And more importantly, has anything truly changed? Because if you don't ask that, you're not trading, you're guessing. Let's walk through it plainly. A hammer appears after a decline. That's the textbook. But a decline of what kind? A weak drift downward, or a strong, relentless sell-off? Because when the selling is strong, when institutions are distributing positions, a single candle doesn't reverse that. It pauses it, and there's a difference. A big difference. When a trader buys every hammer he sees, what happens? He enters too early. He buys into weakness. And weakness, more often than not, continues. That's the cause. The effect. Small losses piling up, confidence eroding, until he starts questioning the very method he never truly understood in the first place. Now, I'm not saying the hammer is useless. Far from it. But it is not a command. It is a clue. And a clue must be confirmed. You want to know the reality of hammer candles? Here it is: they don't signal reversals. They signal potential. And potential without confirmation is nothing more than hope dressed up as analysis. So what should you do when you see one? First, look at the context. Always the context. Is the market in a clear trend, or is it choppy, undecided, moving sideways? Because in a sideways market, a hammer means very little. It's just noise. But in a strong trend, it might mean something, or it might not. That's why you don't act yet. You wait. Yes, wait. That's the part most traders cannot do. You wait to see what happens next. Does the next candle confirm strength? Does price move higher with conviction? Or does it stall, hesitate, and then fall again? Because if it falls again, that hammer wasn't strength, it was absorption. Sellers letting buyers step in just long enough to provide liquidity before pushing the price lower again. Have you ever bought a hammer only to watch the market drop right after? Of course you have. Every trader has. And the reason is simple. You acted on appearance, not on evidence. Now think about this. If a hammer truly represents strong buying, then what should follow? More buying. Not hesitation. Not indecision. Strength should lead to strength. That's the cause. And effect you must train your eye to see. So here's something practical. When you see a hammer, don't buy it. Observe it. markets low, markets high, and then watch how price behaves around those levels. If the low gets broken easily, what does that tell you? That the so-called rejection was weak, that buyers didn't defend the level, that the story the candle told was incomplete. But if the price holds above that low and begins to build higher, now you have something, not certainty, but structure. And structure is what you trade. You see, the market is not about single candles, it's about sequences, relationships, cause and effect over time. One candle is a word. A series of candles, that's a sentence. And only when you can read the sentence do you understand the message. Most traders are stuck reading single words and trying to guess the meaning, and that's why they struggle. Now let me ask you, why do you think the hammer pattern is so popular? Because it's simple. Because it gives the illusion of clarity, and because it promises something every trader wants, a turning point. But the market doesn't reward desire, it rewards discipline. If you rely on the hammer alone, you are relying on simplicity in a game that punishes it. Instead, you must build a method, a way of thinking. When you see a hammer, you ask, what trend am I in? Where is this forming? At support, in the middle of nowhere, after exhaustion, or in the early stages of a move, and then you wait for the market to prove itself. Because proof comes after the signal, not with it. And here's something else most won't tell you. The best opportunities don't feel obvious when they happen. They feel uncertain. They require patience. And they require you to act not when the candle appears, but when the market confirms your interpretation of it. That's the difference between a trader and a speculator. A speculator reacts. A trader waits, observes, and then acts with purpose. Now consider your own behavior. When you see that hammer, what do you feel? Excitement, urgency, the fear of missing out. That's not the market speaking. That's your psychology. And if you let that drive your decisions, the market will take your money as surely as gravity pulls a falling object downward. So you train yourself, you slow down, you detach from the candle and focus on the story behind it. Because the hammer is not the truth. It's a hint of the truth. And the trader who learns to distinguish between the two begins to see what others miss. He begins to understand that the market is not a place of patterns, but of behavior. Not shapes, but intentions. Not signals, but probabilities. And once you see that, the hammer stops being something you chase and becomes something you interpret. And that shift, that quiet shift in how you see a single candle, starts to change everything about how you approach the market. The market has a habit, an old, familiar habit, of showing its hand just enough to lure you in, and then taking it back when you've already committed. The hammer candle is one of its favorite tools for doing just that. It creates the appearance of strength where there may be none. It invites you to believe that the worst is over. But let me ask you, who benefits when you believe that too quickly? Think about what happens inside that candle. Price drops, sometimes sharply. Weak holders panic. Late sellers jump in. Then suddenly, price rises back up, leaving that long tail behind. It looks like buyers stepped in with force. It looks like support held. But what if those buyers weren't strong hands building positions? What if they were simply liquidity? You see, large operators don't chase price the way small traders do. They position themselves. And to do that, they need someone on the other side of their trades. When a hammer forms, it often attracts eager buyers. Traders who see a reversal signal and rush in. But that buying pressure can serve a different purpose. It gives stronger players the opportunity to sell into strength quietly, without moving the market too much against themselves. So when a trader buys immediately after seeing a hammer, what is he really doing? He's stepping into the role the market needs him to play. He's providing liquidity. And when enough traders do that, the market has what it needs to continue moving in the original direction. That's the trap. It's not that the hammer is false. It's that it's incomplete. It shows rejection of lower prices, but it doesn't guarantee acceptance of higher ones. And there's a difference, a very important difference. Now consider this. If the hammer truly represented strong demand, what would you expect next? Price should move higher. It should follow through. Buyers should defend their ground and push upward with consistency. But how often do you see a hammer followed by hesitation, by sideways movement, or worse, by another drop? That's not strength. That's a lack of conviction. And when there is no conviction, the market tends to drift back toward the path of least resistance, which, in a downtrend, is lower. So the trap is not in the candle itself. The trap is in the trader's reaction to it. The moment you assume that the hammer means reversal, you stop thinking. You stop observing. You act too soon, and the market rewards that kind of behavior in only one way: loss. A more disciplined approach changes everything. When you see a hammer, you don't act, you study. You ask, did this candle actually shift momentum, or did it simply interrupt it? Is volume supporting this move, or is it thin and unreliable? Are buyers stepping in again after the hammer, or was that a one-time reaction? Because if buyers don't return, the message is clear. The market tested higher prices and rejected them. And here's something worth remembering. Traps are most effective when they look like opportunities. The cleaner the hammer, the more obvious it appears, the more traders it attracts. And the more traders it attracts, the more useful it becomes for those who understand how to use that behavior against the crowd. So you begin to watch differently. You begin to notice that the best trades often come not from the hammer itself, but from what happens after it fails. When price breaks below the low of a hammer that everyone trusted, what follows is not hesitation, it's acceleration. Because all those trapped buyers are now forced to exit, adding fuel to the move. That's cause and effect. That's the market in motion. A single candle has a way of speaking loudly to the untrained eye. It stands out on the chart, clean, defined, easy to recognize, and the hammer, in particular, seems to carry authority. But let me ask you, since when did the market ever allow one moment to outweigh the weight of everything that came before it? A trend is not built in a candle. It is built in time, in repetition, in pressure applied again and again until the market bends in one direction. So when you see a hammer forming against a strong trend, what are you really looking at? A reversal or just a pause? Because that's what most single candles are, pauses. Brief interruptions in a larger movement. And if you mistake a pause for a turning point, you position yourself against momentum. And momentum, more often than not, does not forgive that mistake. Think about a strong downtrend. Lower highs, lower lows, sellers in control. Then a hammer appears. Price dips and recovers. It looks like buyers stepped in. But ask yourself, have the sellers disappeared? Have they lost control? Or are they simply taking a breath before continuing? Because if the selling pressure remains, it will show itself again. And when it does, that hammer becomes insignificant. Just another candle in a sequence that continues downward. This is where most traders go wrong. They give too much importance to what is recent, what is visible, what stands out. They forget that the market has memory, that every move is connected to the one before it, and that a single candle, no matter how convincing, cannot erase the structure that already exists. So when a trader buys based on one hammer in a downtrend, what is he really doing? He is betting that one moment of buying is stronger than a sustained period of selling. He is ignoring the imbalance that has already been established. And more often than not, that imbalance reasserts itself. That's the cause. The effect is predictable. The market resumes its direction, and the trader is left holding a position that was never aligned with the bigger picture. Now, does that mean a single candle is useless? No, but it must be placed in context. Always in context. A hammer at the end of a long, exhausted trend, near a significant level, followed by strong confirmation. That has meaning. But the candle alone, it tells you very little. You have to ask, what is the trend doing? Is it accelerating or slowing? Are pullbacks shallow or deep? Are buyers consistently stepping in, or only appearing once in a while? Because trends leave clues, and those clues matter far more than any single formation. If you train your eye to see only the candle, you will miss the story. And trading is not about reacting to shapes. It's about understanding behavior. Let me put it simply. A single candle is an event. A trend is a condition. And in the market, conditions outweigh events every time. So when you see that hammer appear against a strong trend, Don't be impressed by it. Be skeptical. Ask yourself, what has actually changed? Has structure broken? Has momentum shifted? Or is this just a temporary reaction within a larger move? Because if nothing has changed, then nothing has changed. And acting as if it has is where the trouble begins. Most losses don't come from ignorance. They come from overconfidence in something that looks clear but isn't complete. And the single candle is often the perfect example of that illusion. It gives you just enough information to act, but not enough to be right. So you slow yourself down. You remind yourself that the market is bigger than any one moment, that trends carry weight. That pressure builds over time. And that one candle, no matter how appealing, cannot stand against that weight on its own. There is a moment in every trader's journey when he sees a hammer candle and feels the urge to act. It looks clean. It looks decisive. It feels like the market has just handed him an answer. But let me ask you, since when did the market give answers before asking questions? The hammer is not the answer. It is the question. And the only way the market answers that question is through what comes next. You see, most traders stop their thinking at the candle itself. They see rejection, and they assume reversal. They see a long, lower shadow, and they believe buyers have taken control. But control in the market is not proven in a single moment. It is proven in continuation, in follow-through, in the ability of price to move and hold beyond that one candle. So when you act on the hammer alone, what are you really doing? You are acting on expectation, not on evidence. An expectation in this business is a dangerous companion. Let's slow it down. A hammer forms. Fine. Price dipped, then recovered. Buyers showed up. That much we can agree on. But were they strong buyers, or just temporary participants? Did they step in with intention to push the market higher, or did they simply react to price reaching a level? Because there's a difference between reaction and commitment. And that difference reveals itself in the next candles. If the buying is real, if it carries weight, then the market should not hesitate. It should continue upward. You should see higher closes, steady pressure, perhaps even acceleration. That's what strength looks like. It doesn't ask for permission, it moves. But what if the next candle stalls? What if price moves sideways or worse, starts drifting lower again? What does that tell you? It tells you that the hammer was not a shift in control. It was a momentary pause, a flicker, not a flame. And yet, how many traders ignore that? How many enter on the hammer, only to sit through hesitation, hoping it will turn in their favor? That hope is costly. Because when confirmation is absent, uncertainty is present. And uncertainty is not where you build positions. Now consider the opposite. You wait. You let the hammer form, and you do nothing. You observe. The next candle comes, and it pushes higher. Then another follows. Price begins to build structure above the hammer's high. Now what do you have? You have agreement. The market is confirming what the hammer suggested, not guaranteeing, but supporting. And that changes everything. Because now you are no longer acting on a single signal. You are acting on behavior that is repeating, on pressure that is sustaining itself. That's where the edge begins. Let me ask you something. Why do you think waiting feels so uncomfortable? Why does confirmation feel like you're too late? Because the mind wants certainty before it has been earned. It wants to catch the exact turning point, but the market does not reward precision. It rewards patience. When a trader jumps in early, he feels clever for a moment. But when the market doesn't follow through, that cleverness turns into doubt, and doubt leads to poor decisions. Exiting too soon, holding too long, or jumping into the next signal without thought. That's the cycle. But when you wait for confirmation, you shift the odds slightly in your favor. You align yourself with what the market is actually doing, not what you think it might do, and that's a different game altogether. Here's something practical. When a hammer forms, mark its high and its low. Let those levels guide you. If price breaks above the high and holds, that's information. If it fails to do so, that's information too. If the low gets broken, the message becomes even clearer. The supposed strength was not defended. You don't need to predict. You just need to interpret. Because confirmation is not about being late. It's about being right more often than wrong. It's about trading with the market, not ahead of it. A single candle can suggest, but only the candles that follow can prove. And once you begin to trust that process, once you stop rushing to act and start waiting to see, the chart begins to speak in a different way. Not in signals, but in sequences. Not in promises, but in probabilities. If a hammer truly represents strength, then that strength should not hesitate. It should not ask for permission. It should not fade quietly into the background. Strength in the market has a certain character. It follows through. Now let me ask you, how often have you seen a hammer form, felt that surge of confidence, and stepped in, only to watch the next few candles do nothing? No push upward, no urgency, just sideways movement, or worse, a slow drift back down. What happened to that strength you thought you saw? It was never confirmed. You see, a hammer suggests that buyers stepped in at lower prices. But suggestion is not proof. The real proof comes after. If those buyers were truly committed, if they had size, intention, and control, then price should reflect that. It should rise. It should build on that initial push. Because real demand does not disappear after one candle. So when the market fails to move higher after a hammer, what is it telling you? It's telling you that the buying was either weak or temporary, that the effort was not enough to shift the balance. And in this business, effort without result is a warning sign, always. Most traders ignore that. They focus on what they saw, not on what is happening. They cling to the idea that the hammer means reversal, even as the market quietly disagrees. And when you hold on to an idea that the market is not supporting, you place yourself in conflict with reality. And the market always wins that conflict. Think about cause and effect. If strong buyers enter the market, price should rise. That's the effect. If price does not rise, then either the buyers were not strong or there were stronger sellers absorbing that demand. In both cases, the conclusion is the same. The upward move is not ready. Yet traders continue to buy into that hesitation, hoping that the next candle will finally deliver what the first one promised. That's not trading. That's wishing. A more grounded approach changes the entire picture. When you see a hammer, you treat it as a starting point, not a conclusion. You watch what follows. Does price move up with clarity? Do buyers step in again, reinforcing that initial move? Or does the market stall, as if unsure of itself? Because hesitation is information, and in trading, information is everything. If the next candle after a hammer closes weak, or fails to push beyond the hammer's high, you take note. If the market begins to compress instead of expand, you take note. These are not random movements. They are signals of indecision, of imbalance not yet resolved. And when imbalance is not resolved, the path of least resistance often remains unchanged. Let me put it plainly. A hammer without follow-through is like a spark that never becomes a flame. It may catch your attention, but it doesn't sustain itself. And without that continuation, there is no edge, only uncertainty. Now consider the opposite. The hammer forms and the next candle drives higher. Then another follows, building structure above the previous high. Momentum begins to shift. Now what do you have? You have evidence. You have alignment. You have something that can be worked with. That's when you pay attention. Because the market is not just showing you a reaction, it is showing you commitment. And commitment is what moves price. So you train yourself to think in terms of sequence. Not just what happened, but what happened next. Because the next is where the truth reveals itself. The hammer is only the opening move. The real story unfolds in the candles that follow. Ask yourself each time, did strength lead to strength, or did it fade? Because the answer to that question will tell you far more than the hammer ever could. And once you begin to rely on that logic, once you stop trusting isolated signals and start watching for continuation, you begin to align yourself with how the market actually behaves. A hammer candle by itself means very little. But where it forms, that's where the story begins to take shape. Let me ask you something. Would you value the same signal the same way, no matter where it appears? Or does location change its meaning? Because in the market, location is everything. A hammer forming in the middle of random price movement in a choppy, directionless zone is just noise. There's no structure there, no clear battle, No defined level where buyers and sellers have shown commitment before. So what is that hammer rejecting? Nothing of importance. It's like a reaction without a cause. And when there's no cause, the effect is unreliable. But place that same hammer at a well-defined support level, somewhere price has reacted before, where buyers have previously stepped in, and now the situation changes. Now the candle is not just a shape. It's a response to a known area. It's the market interacting with a level that already holds meaning. Do you see the difference? One is random, the other is contextual. Most traders ignore this. They treat every hammer the same, as if the market operates in isolation, candle by candle. But the market is not a collection of separate signals. It's a continuous flow. Every movement connects to a level, a zone, a prior decision point. So when you see a hammer, the first question is not, what does this candle mean? The question is, where is this happening? Because location tells you who might be involved. At key levels, larger players pay attention. They have memory. They recognize areas where price has turned before, and when price returns to those areas, their behavior becomes more deliberate. So if a hammer forms there, it might reflect real interest, not just short-term reaction. But even then, you don't assume. You observe. Now consider the opposite. A hammer appears in the middle of a range, surrounded by messy price action, no clear direction, no defined boundaries. What are you really looking at? A fluctuation, a temporary imbalance that may not matter in the next few candles. And yet, how many traders take that as a signal? They enter without asking where they are, without understanding the environment, and when the market doesn't respond, they're left confused. But the market didn't fail, the interpretation did. Here's something practical. Before you even consider the hammer, step back. Look left on the chart. Identify where price is in relation to past structure. Is it near a level that has held before? Is it testing a previous low? Is it approaching an area where buyers or sellers have shown strength? If not, then the hammer carries less weight, because the market respects levels, not patterns. Let me ask you this. Why do you think price reacts at certain points over and over again? Because that's where decisions were made. That's where positions were built, defended, or unwound. Those areas matter, and when a hammer forms at those points, it's not just a candle, it's a reaction to memory. Now, does that mean every hammer at support will work? No. Nothing in this business is certain. But it does mean that the odds are different, that the context gives the signal meaning, and in trading, meaning is what separates noise from opportunity. Cause and effect again. When price reaches a strong level, participants react. That reaction can produce a hammer, and if the level holds, price moves away. But if the level breaks, the hammer becomes irrelevant. The location was tested and failed. So you don't just watch the candle. You watch the level. You watch how price behaves around it. Does it hold? Does it break? Does it hesitate? Because the hammer is only part of the equation. The level is the foundation. And once you start thinking this way, something shifts. You stop chasing patterns across the chart. You become selective. You wait for the right place, not just the right shape. You begin to understand that a hammer in the wrong location is not just weak. It's misleading. It invites you into trades that have no structural support, no real reasoning behind them. And trades without reasoning rarely end well. Most traders are drawn to what they can see. A clean hammer forms, the shape is clear, the story feels obvious, and they act. It feels logical, almost automatic. But let me ask you, if trading were as simple as recognizing shapes, why would so many struggle to stay consistent? Because the shape is not the trade. The behavior around it is. You see, amateurs are trained to spot patterns. They memorize formations, give them names, attach meaning to them, and then react the moment they appear. But the market is not obligated to respect those names. It doesn't care what you call a candle. It only reflects the actions of participants. Buyers, sellers, hesitation, aggression. And that behavior doesn't begin and end with one candle. So when a hammer appears, the inexperienced trader sees completion. A finished signal. A green light. But the professional sees the beginning of a process, something that needs to unfold, to be tested, to either prove itself or fall apart. That difference in perspective is everything. Let's slow it down. A hammer forms after a decline. The shape suggests rejection of lower prices. Fine, but what happens next? That's where the real information lies. Does the market accept higher prices? Do buyers return with consistency? Or does the price hesitate, drift, and eventually fall back? Because behavior is revealed in continuation, not in appearance. Now think about this. Two traders see the same hammer. One buys immediately, the other waits. Who is in control of his decision? The first trader is reacting, the second is observing. And in this business, the one who observes has the advantage. Why? Because he is gathering information before committing capital. The market is constantly sending signals, but not all of them are meant to be acted on. Some are tests. Some are traps. Some are simply noise. And if you treat every visible pattern as a trade, you become predictable.